Adk Wealth Advisory Group. Today I'm joined by team member and certified financial planner Rich Kurowski. Our education topics today are really three. First is to focus in on a look back historically at different types of financial crisis, when they were, what caused them. Second is to take a look at a more current situation around the Europe, Ukraine, and Russia. And then the last is to kind of look forward at some of the promises that have been made by the United States government around things like Social Security and Medicare. Today be focusing on Social Security. A financial map that is always a point of reference for us to review is the secular bear and secular bull chart. You can see on the chart up on your screen that you have these long extended secular bulls illustrated in green. Then you have that followed by an extended pink period called secular bears. What we really want to talk about today is what causes those pink periods. In a book that I've recently been reading, Manias, Panics, and Crashes, A History of Financial Crisis by Charles Kindenberger, his theory is that extended credit or even excessive credit fuels these manias, if you will, around different asset classes like real estate, commodities, stocks, and even in more recent phenomenons, currencies themselves, that result in prices going to levels that we have recently been calling bubbles. And the net effect is at some point there's an event, normally driven by fear, that pricks or pops that bubble that creates a crash in those prices. And some of those crashes result in financial crisis. When that financial crisis results, it extends beyond multiple borders. It doesn't just stay within one country. So for example, if you look back under Kindenberger's 400-year glance, there's some debate as to when that first bubble actually happened, whether or not it's around 1618, where you had debasement of coins, or more like around 1636, where you had tulip mania. And tulip mania is pretty interesting because if you take a look at what occurred in the Dutch area, you can imagine as we get ready to approach spring, as I'm looking outside, that a tulip bulb, quite a beautiful thing when it extends into the flower itself, but one tulip bulb during that period of time was exceeding 10 times the annual wages of a skilled craftsman. So clearly the prices got outrageous. And what was the result of that mania was a fueled credit where people who were selling the bulbs were actually extending credit to the buyers. So one of the things that Charles talks about is that the extension of credit doesn't always happen in the way we think of it being extended by banks. There's a lot of uniqueness in how the currencies and money pool expands during these periods of mania. If you go into the 1700s, you can also see the South Sea and the Mississippi Company, where there was such demand for the company shares that both kings and paupers were throwing money into the bin. In many cases, kings were sending money across seas on ships so that they could buy something in the terms of the shares of those companies. Once again, the price of these companies fueled the areas mania-wise that really had no real value in the hindsight of looking back. But during that period, there's enough euphoria where people just think that it will continue. Again, that crash resulted in a financial crisis that extended beyond borders. If you go into the 1800s, many of us remember the Civil War, but there was an enormous industrialization that happened in America with railroads, and there was a lot of mania and crisis that occurred from that. Much of that stayed within borders here, so some of it did not turn into crisis. But as we go into the early 1900s, again, we'll go back to that secular bear and bull chart. You can see the very first one illustrated is 1907, that time frame. What happened, which is pretty interesting, a book that I've read, The House of Morgan, An American Banking Dynasty by Ron Chernow, he outlines how during that period you had the formation of trust companies, much like what we think of as holding companies. And it provided a platform where they pooled multiple companies together, in many cases things like railroads, where people were bidding for shares of this trust company, and the ultimate reality is it drove the stock market to levels that, once again, mania-wise, were not sustainable. And then again, you can see that a crash occurred and extended for a long period. Across the pond, if you take a look at Italy and France, you see something that was happening that was different, where they were starting up a lot of new banks, but the net effect was the same, is that you had new money, you had excessive credit, mania fueling things to levels that were not sustainable, and then when that bubble popped, you saw not only in the United States, but over in Europe having financial crisis. Continuing on within this modern period of over the last 100+ years, something that we're more familiar with is the Great Depression. We've all seen in history class where people were able to buy stock on margin. In this particular case, they were able to put 10 cents of every dollar onto investments. Net effect is they borrowed 90%. Again, we had an expansion and a fueling of mania, driving prices in the stock market to a bubble territory. But across the pond, something that I don't recall studying in school was you also had a period of post-World War I where you had a lot of economic expansion, where farms that had been decimated were producing again, and a lot of other ag business. So you had all of a sudden an excess of cotton and a lot of other products that contributed to the problems as well. And we all know the history of how that financial crisis really extended across borders and for a long period of time. If you go into the 1970s, again, you can see we had an extended secular bear market during that period. One of the things that I thought fascinating as I was studying this is it's really the first time that we see derivatives coming into being one of the major parts of what fueled excessive credit that created some of this bubble, if you will. There's an organization called the Bank of International Settlements, BIS, and it's located in Basel, Switzerland. And it's been around since the 30s, but in the 70s they created a mechanism called swaps that really extended credit significantly. And once again, we see other parts of the country and other parts of the world being affected by this. And then we're all aware of what occurred in the 2000s. I won't belabor the point, but again, we had extended credit. We had mania fueling prices on things like stocks, real estate, and the net effect of it was a financial crisis throughout the world. Now, some of the problems with that is after you've had a couple of those types of financial crisis, every time something runs up in price, we start to wonder, is this another crash that's going to result in a financial crisis? If you take a look at one measurement on how we measure the value of stocks, it's called a PE ratio. If you look historically at the United States stock market, an average PE for the US market's around 15. If you look at the US S&P trailing 12-month PE, it's around 16.5. If you look at the forward PE, it's about 15.3. While those are premiums compared to normative, I don't see them being something that is so excessive that creates a real risk of a crisis resulting from overvaluation in the US stock market. We've talked about things like excess credit creating mania. One of Kindleberger's theories also is about wars and how they affect that. So if you come to something that's a little bit more current time, if you did take a look at Europe, Ukraine, specifically Crimea, and you take a look at Russia, this is one of those situations that really could position itself where it could extend and propagate into a war. I think the probability of that is very low, even though it's a possibility. And the reason why is if you take a look at Europe, Europe's importing of energy from Russia is nothing short of staggering. They are very dependent on Russia for their natural gas and for their petroleum. Some articles that were recently written in the Wall Street Journal, as well as the New York Times, would cause me to summarize it by saying somewhere between a third and half of all the energy that Europe needs comes from Russia. I don't think Europe has the ability right now to really push back on Russia because of this very issue. If you take a look at the White House, we have a policy of what we call a pivot, where we want to pivot away from the Middle East and to the Far East. The likelihood that after spending money in 2 wars in the Middle East, that we're going to want to go spend money on a war in Eastern Europe, I would say it's very low. Those 2 points, the pivot and Europe's energy dependence on Russia, cause me to believe that NATO will be quite impotent on this particular subject matter. And when you really take a look at Putin, I mean, he is a very intelligent, shrewd, powerful, ex-KGB dictator, president. And when I really take a look at Putin, I think if you go back and you take a look at what he did in Georgia, and you take a look at what's going on in the Ukraine, I think those are going to continue to happen within that ex-USSR bloc. I think he'll be intelligent enough to spread them out like he did between the 2 most recent, so that he doesn't force NATO's hand. But in the end, I think he'll continue to flex his muscle and annex areas that are strategic for him, or else just flex muscle to create fear in areas where he wants strategic alignment with countries like Georgia, etc., towards Russia instead of Europe. So in summary on the first 2 points, when I think in terms of the short term, say 12 to 18 months, I think it's very unlikely that financial crisis results from either of those 2 areas. As we talk about future topics, we'll look at other areas as well. The area in this part of the world that really concerns me is the promises that have been made to the baby boom generation around Social Security, Medicare, and really when you take a look at the numbers, our inability to meet those promises. So Rich is going to cover the topic of Social Security.
As Dan mentioned, we're going to spend a few minutes talking about the Social Security and Medicare systems, and we'll also be posting articles on the ADK Facebook page. These are going to go into more detail about the subjects and also talk about some of the options and solutions for the programs. So take a look at those articles on the Facebook page and use that page and let us know what you think. Now, there at the core of the Social Security system are the 4 trust funds. These funds are, first, the Old Age and Survivor Insurance Trust Fund, which covers retirement and survivor benefits; the Disability Insurance Trust Fund, which covers disability benefits; the Hospital Insurance Trust Fund, which pays inpatient hospital and related care benefits, or Part A Medicare benefits; and the Supplementary Medical Insurance Trust Fund, which covers physician and outpatient benefits through Medicare, or Part B benefits, and also Part D prescription benefits through Medicare. As of today, costs exceed revenues in 3 of these 4 funds, and in the fund where costs aren't exceeding revenues yet, they are exceeding the revenues coming in through payroll taxes, which were meant to be the sole source of income for that fund. Again, that's the Old Age and Survivors Fund. Now, when costs in the funds exceed tax revenues and premiums, first option is to use interest on the fund reserves to fund benefits, and then the last option is to start liquidating the reserves themselves. After that, benefits can only match the level of income that is coming in through payroll taxes and premiums. Now, today's projections show the Disability Fund running out in 2016. The Part D and Part B Medicare Fund will run out in a little over 10 years, and the Old Age and Survivors Fund will run out in 2033. What's important to note, though, is that long before these funds run out of money, we're going to face a situation where the costs exceed revenues by larger and larger amounts, and the gap between these costs and revenues is going to expand at a faster rate. The graph you see on the screen now shows the gap between cost and revenues rising sharply in just the next 3 years, starting in 2017. This gap is going to have to be covered by tax increases, benefit cuts, our general revenue subsidies, or some combination of the 3. And again, this starts in 2017. Now, we're all familiar with the source of the problem. There's too few workers to support the growing number of benefit recipients. Back in the 50s, the ratio of taxpayers to recipients was close to 9. Today, that ratio has dropped to just below 3, and in the next 10 years, that ratio is going to drop to 2. I like to use analogies for illustration purposes, and the one that comes to mind is going to the beach and wading out into the ocean. At first the waves are small and you have no problem walking through them. Eventually the waves get larger, but they're still troughs where the water's calm and it's easy to move in. Finally though, get to the point where the waves have been building and they hit you and they knock you over and they maybe even submerge you. Well, today in 2014, one of those large waves is building and it's about to hit us. There are options for dealing with this wave, and the sooner we start working on those options, the better. So in the next video, we'll talk about some of those options for Social Security. But as I mentioned earlier, take a look at our Facebook page, look at the articles that we've posted there, and let us know what you think about some of the thoughts we include in them. Thanks.
In wrapping up, we really covered 3 topics today, all combined around one major issue, and that is do we see a financial crisis imminent? And I would say that when I take a look at United States / North America, Europe, Russia, in the short term, I don't see any evidence that causes me to have real financial concerns of a crisis. Now, when I look at places like China, the answer to that's a little different. So in our next market update, I'm going to dig into China. When I move away from the short term and I take a look at the intermediate term, say 2015 to 2020, I do have concerns when I take a look at North America, primarily because when you take a look at crisis, a lot of the panic that starts is a function of not being able to pay something that you've promised. And when I take a look at Social Security, when I take a look at Medicare and Medicaid, and then some of the other government agencies like the PBGC that insures pension funds, I do have concerns about our ability to pay that. But again, that's more intermediate term focused. In conclusion, I'd like to thank you for the trust that you place in our team at ADK Wealth Advisory Group. If you haven't already liked us on Facebook, I would encourage you to go to ADK Wealth Advisory Group. If you don't use Facebook and LinkedIn is more your style, my personal LinkedIn page is Dan Davis. If you don't use any of those, let Rich or me know, and what we'll do is have these updates sent via a link email. Again, thank you very much and farewell.